Welcome to Real Estate Hot Wired. Maggie Rose March will be your host today. She is an informed voice for the novice investor, a voice of reason for the seasoned investor. And we'll be right back.
Hi, I'm Maggie Rose, and this is Real Estate Hot Wired. Today we're talking with Tony Moore from GULFSIDE Mortgage about the golden age of real estate, managing your real estate portfolio. First, I'd like to introduce you to Tony. Tony Moore is the co-branch manager and a licensed loan originator of GULFSIDE Mortgage Services. He is originally from Cincinnati, Ohio, and moved here to Sarasota County over 23 years ago. Tony began his career as a mortgage loan originator in 2002, and he and his wife took over GULFSIDE Mortgage Services in 2010. He is also currently the chairman of the Venice Area Chamber of Commerce for 2020. He is a respected professional in Sarasota County and is dedicated to helping people and helping his community. Tony, welcome to Real Estate Hot Wired.
Thank you, Maggie. I appreciate it.
I'm excited about today's show because I know we can change some people's lives today with some of the information that we're going to be sharing. I know Florida is a favored second home or vacation home location among many retired or semi-retired persons. And we see that in our rental market as well as in our home sales. Can you tell us a little bit about that second home market and vacation home purchases from your experiences as a mortgage broker?
Yeah, absolutely, Maggie. That's one thing that we see a lot down here. Being in Florida, there's so many people that are either own second homes down here, or like you mentioned, do a lot of rentals down here, rent second homes down here, or vacation homes. Sometimes it's even their third home. They have other rental properties or other properties, other places too. But we work with a lot of folks that end up moving to Florida or purchase a second home here and end up making it their future primary residence a lot of times. And it's just it's not a hard process to go through, whether you're looking at rentals or purchases. And obviously right now it's a wonderful time to purchase. There's a lot of different things that you can do with the purchases, a million reasons why they'd want to get into. And obviously we do have a huge second home market down here.
And I don't know what you think, but I think it's actually cheaper to purchase than to rent for 3 months. What is your take on that?
Well, I actually do see a lot of people nowadays that are currently coming to me, and they figured out that over the last 5-10 years that they've been doing a seasonal rental down here, they could have owned a home during that time or paid for it with the amount of money that they were paying in just the 3 months they were visiting down here. Because when seasonal rentals, they're marking up those rents by, you would probably know better than me, but they're marking those rents up 3-4 times the amount of what they get on an annual rental.
Exactly. They're getting almost the year's rent in that short period of time.
Absolutely.
And there's some advantages for them to that. We are an investor-friendly show, so we understand that. But
Absolutely.
This second home, it's an investment as well. Or third home. Certainly by the time you've bought a third home, you're thinking about it in terms of that you've got quite a bit of your equity invested. Your holdings are in real estate. So
right.
When they're purchasing, what programs do you have, and what are the down payment requirements for something like this?
Okay, well, there's a lot of different options for folks that are purchasing second homes here in Florida. The minimum down payment that's required is going to be a minimum of 10% down. A lot of people do think that you need at least 20% down, and some actually think you need 25% down, but you can purchase for as little as 10% down, so you can get your foot in the door and get the purchase in. When you do put 10% down, you will have the mortgage insurance premium. And the good thing about the mortgage insurance premium that people don't understand with conventional loans is that as soon as you pay your mortgage down to the original 20%, the mortgage insurance goes away. So if you're waiting to sell your house and then move down here in a couple of years, or even the equity goes up after 2 years, you can have that mortgage insurance removed. So it's some great options.
And that
Um,
isn't that's not true with the government loans. These are for the conventional mortgage. Am I understanding that?
yeah, absolutely, Maggie.
Okay.
You mentioned that, but the government loans, the USDA, FHA, and VA loans that are available, those are all for primary residence only. So we wouldn't be able to use one of those for the second home purchase.
That clears that up.
Right. But for those second home purchases, if they're looking to put down the money, obviously the 10% down would have the mortgage insurance, but it's going to have a really good rate. And then 20% down would be no mortgage insurance. And a lot of people think that when you put 20% down, you're actually getting the best interest rate available, which is actually it's false. You actually get the worst interest rate available with 20% down because that's the highest limit that banks are willing to lend you without being insured by a private mortgage company, mortgage insurance company. So think about it. They're borrowing the max they can, and they're all the liabilities on them. So that's where the rate's actually higher. When you end up putting more money down is when your rate actually goes down, and 25 or 30% down, you would actually get a little bit better rate than you would interest rate than if you would put down just 20.
Now that's what we like to do. We love to dispel those myths and get
Right.
really good information out there for people.
Right.
That's important.
Now, putting 20% down is great, obviously, because you do avoid the mortgage insurance,
Yeah.
which only insures the lender in case if you default, and nothing for you, which is another myth that some people believe is the mortgage insurance insures you as a borrower. It actually insures the lender in case you default, which is good to know.
Yes, excellent. So, Tony, with the many options that are available to purchasers
Hmm.
in this, let's say the golden age demographic, what would be the advantages to purchasing their second home now, say to switch into their primary retirement home in the future? In other words, they want to retire here, but not for another 5 years or not for another 7 years. How, why, and how could that be accomplished, or should
Well,
it?
yeah, absolutely. The number one reason is cost of waiting. And cost of waiting
Mm,
just comes through of, well, what's the interest rates going to be when you're ready to buy? What
mhm.
is the house values going to be when you're ready to buy? How much money are you going to spend on rent between now and then until you're ready to buy to come down here? And when you put all those factors together, I actually put together a small graph here to show these numbers. And I did it on a $350,000 purchase to purchase today
Mhm.
at a 3.75% interest rate, just to give us a ballpark rate. And the cost to wait 6 months to purchase the same home would cost you $8,450 more if you bought it 6 months later. The same home to purchase a year later would cost you over $17,000. 2 years later would cost you over $32,000. And if you waited just 3 years to purchase, that same purchase is going to cost you over almost $53,000 more to buy the same $350,000 house 3 years from today, with counting appreciation, payment difference, money out of pocket, amortization lost, putting all that together. I mean, that's a huge chunk of a house that you could buy when you're spending that much more on it in 3 years from today.
Now that those are numbers I understand, and I hear that and I try to explain that sometimes to my buying customers,
Hmm.
and I don't know that they always hear that. And of course, rents don't stay the same. If you come down here and you're renting,
That's
you're
correct.
going to pay more and more, or renting, and whether it's for your primary or a secondary, you're going to pay more for that rent. In very rare cases do you not pay more on that rent. so
Right.
so and the fact that you can rent your second home, how many, is it 90 days or 100, how many days can you rent a second home for?
Yep. So that's a great question to get into also. And let's just kind of explain what we're talking about with that, Maggie.
Okay.
Basically, what you're saying is, hey, let's, instead of me coming down and renting my second home and renting a place to live, a vacation home, a vacation rental, let's purchase that home. Let's come down and visit the second home when we want to. So whatever months of the year that we want to. And with Fannie and Freddie Mac, Fannie Mae and Freddie Mac, their guideline actually states when you purchase a second home and get a loan for a second home, you must occupy the property as a second home throughout the year, which you will. But it also states that you're allowed to rent the property out for up to 90 days per year. So
90
up to 3 months.
days.
Yeah. So that means that, let's say that you have a few months that you want to come down, maybe spring break if you have children, maybe the summertime if you have children, maybe there's other times that you'd like to come down to go golfing, or if you're a fisherman or whatever it is. Well, you can come down during those times and use the home as your second home. But then let's say you're not going to be here for the month of March. Well, you could rent that house out for the month of March, get what a seasonal rental brings in, and use that money towards making your payment and have the equity to grow for you because you're the owner of the property now. So it's a great way to supplement your mortgage payment, your tax payment, your insurance payment by renting it out a month or two, or even up to 3 months per year.
So if I'm understanding you correctly, and I appreciate that 90 days, I forgot what that was.
Right.
That cost of waiting becomes part of that gain to you by purchasing now versus later. Am I understanding that? Am I processing that correctly?
Well, actually, with those numbers I gave you, which was almost $53,000 in 3 years that you would lose or pay more for the house, that rental is not even included in there. So let's say that you rented it. Yeah. So let's say that you rented this place. Let's say you bought a $350,000 house and you're able to rent it out for 3 months at $2,500 a month. Well, now you're looking at $7,500, $7,500 a year more times 3 years. Well, that's an extra $22,500 that you missed out on that could go towards your payment or go in your bank account or wherever. So that's actually additional to that $53,000.
So, you know what, Tony, this is exciting information. Can you go over that cost of waiting especially for our more novice investor, for people who are less familiar with the cost of waiting? Can you do that one more time and recap that?
Yeah, I'll actually talk about a few of the numbers to kind of give you an idea. But Maggie, just to let you know, any of the clients that we work with, we can put this together on a particular home for them to show them exactly what their number was. These numbers that I have in front of me are generic numbers on a fictitious house. But if they have an actual address and we can get the actual tax bill, the actual insurance bill, we can sit down with them at GULFSIDE Mortgage Services, put these numbers together for them and show them. And we can move these numbers. So if they say, hey, well, I think interest rates are going to go down a quarter in 6 months, we can lower that rate down in 6 months and still show them what the benefit is buying today compared to 6 months, a year, 2 years down the road, which is excellent.
Excellent.
Okay, so back to your question, let's look at the 3-year mark. So today, if you purchased a $350,000 home, it's forecasted that our property values between now and 3 years from today are going to go up 10.55%. So to purchase that home today at $350,000, to purchase it in 3 years, you're going to pay $386,911 for it. So the difference that you're going to be paying for that is over $36,000. So that's part of the money. The second portion is when you pay more money for the house, now your payment goes up. So your payment difference between buying now compared to 3 years at the higher loan amount, because this is based on 20% down, that's $137 a month. Well, 3 years at $137 a month is an additional $1,650. Okay.
Wow. Yeah.
The third thing that we have included in here is the amount of money that you put into the property, right? So this means that when you make a payment right now for rent, that none of that money goes into your pocket. like your 401k or IRA. It goes away completely. You're giving it to the person, the owner